Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets that they didn't make any sense today at all. None, zero, no sense. I'm kind of wondering how many of you tuned in today to see if I'd be crying or upset because macro thesis busted. I know you're all picking on me. I see the posts and stuff. Oh, come on. You don't understand what macro is. Got a lot to go through today. I'm your host, Steven Van Metre, and see, let me tell you what macro is if you haven't figured it out. Many of you are too short-term. You're swing traders or whatever ridiculous stuff that is. You're short-timers. Macro is a long-term play. You look out 3 to 5 years per phase. So my macro thesis is 15 years, somewhere in that range, 9 to 15 years. So people be like, oh, hey, Steve, your thesis is so terrible. It's like, well, yeah, it's at the end of it. Go back a few years and tell me what it looks like then. Phase one is near the end. And no, I don't worry about, days, weeks, or quarters they move against me. It doesn't matter because what is macro? It's long term. It's about looking at the data, assigning probabilities on terms of a variety of outcomes, picking the highest probability of the outcome, putting your chips on the table, and then what? You sit back and wait, and you go through your data, right? You look at your data and say, is it still right? Wow, things are moving against me, but the data is right. That's how you do macro. When you hear people say, I don't care if it goes down after I buy, it's because they're long-term investors. They get how it works. That's what macro is. So it's funny to me that some of you, whining and complaining, oh no, I'm waiting forever for the thesis to play out. The thesis started years ago. But if you're out there running around buying short-term call options on a macro thesis, you're the one who's doing it wrong. You don't buy short-term call options on a macro thesis. That's not how it works. You do it's wrong, no. You're doing it wrong. And so yes, still wearing the crown. Because many of you thought, oh no, Steve's busted. No. Don't bother me at all. In fact, I like it when people bet against me because I actually do the research into the data and I show you the data. Now, you're free to form your own opinion. You don't have to agree with me. This show isn't agree with Steve's macro thesis. Here is my view. We're going to see a deflationary shock, and it's me going through my own personal book, right? Talking my book about here's my data. Me going through it. Someone said, how do you do this every week? I said, look, this is what I do. I'm looking at the data to find where I'm wrong. As long as the data is right, I don't care if the market moves against me because I know in the end it plays out in my favor. It's how I've made the most money trading macro. He's like, how is that possible? It works. All right. So today we had a liquidation event in the market. Of course, there's this ridiculous notion that perhaps since central bankers cannot create inflation, that politicians can. And that's what's going to solve our problem in America is we just have not gotten the right combination of politicians in the House, Senate, and President. And once we get that, then it's all solved. There's going to be inflation because we're just, somehow, the Rubik's Cube is just and the wrong. We just got to get it right. It's desperation. When you have to look for politicians to create inflation, you've got a problem. It doesn't matter how the outcome of the election is. It doesn't change the fundamental picture. Now, maybe in the short term, people will get hyped up of a certain combination on the wheels. Look, all blue, all red, all purple. Who cares? Does it change the view? No, because there's not going to be any stimulus until probably February. And what does that mean for the economy that going into winter, which is the slowest growth month of the year? I mean, look at crude oil and energy stocks. They're already telling you there's no inflation. Now, of course, the market tells you, oh my God, yields got to go up. Up. You have record selling and you can't get to 1.7 on the 30-year. You have record open interest in the futures market. You have massive, persistent, constant selling and you can't get to 1.7. That should tell you what's going on. That all these sellers are going to be wrong. So no, the whole notion that some combination of outcome on Tuesday is going to lead to something, maybe emotionally for investors, but maybe psychologically. But by the time we get to the stimulus checks going out, the economy is going to be in dire shape. We got to answer the question, what do banks want? We got to look at the economic data, why stocks and bonds can fall together. Some of you think these are inversely correlated. They're not. Sometimes they are. Oftentimes they are, but they're not all. Nothing. The only thing is inversely correlated is treasury yields and treasury bond prices. Everything else, I mean, yeah, you can have markets move together. We got to look at the 7-year bond auction. Apparently, there's some confusion over that. We're going to talk about Sorcerer JP and the FOMC. That is their new band. That is Sorcerer JP and the FOMC. Let's get the economic data where we can find a whole lot of no inflation. There isn't any. Let's start with this week. We've got initial jobless claims at 751,000. Now, some of you say that's really good. It's really not good when 751,000 people are filing for initial claims. And again, we're going into the winter. What are we seeing in Europe? Lockdowns. What are we seeing with case counts? We're seeing near record highs. Is that going to lead to a lot of employment? No. And it's certainly initial jobless claims of 751,000 is not inflationary. In fact, here is the Department of Labor release, and this has the total claims. It can be a while to locate this thing, but here we have total unemployment claims is down about 400,000 to 22.654 million Americans are on unemployment. That is not inflationary. In fact, that is as disinflationary or deflationary as you get, because that's 22.654 million people that are making less money than they made before and still have to pay their bills. Now remember, as some of you have told me and been very clear that yes, all these student loans come out of deferment in December. I don't know if it's the end or somewhere in December. Yeah. Do you think these 22.654 million people are loaded up with cash ready to pay all those bills? No. This is about as deflationary as you get. Let's move back into the economic data. See what we've got in here. Pending home sales, month over month fell 2.2, which is kind of a surprise considering how strong the housing market's been. But on a year-over-year basis, it's just off the charts. There will be a point where all these buyers chasing real estate will exhaust themselves. That will come. All right, let's talk about the 7-year note auction. So the news was a terrible auction in 7 years and bonds sold off, and look, nobody wants them. It's interesting that nobody wants them because on a $53 billion auction, primary dealers bid $72 billion. There's $118.5 billion bid, clearly showing there's no demand. I mean, seriously? Now, why do you hear this? Oh, the demand was weak, because all anyone ever cares about is what happens on this row right here called indirect or foreign bidders, which is mostly foreign central banks. Everything else doesn't matter. And when foreign investors do not buy a lot, then everyone assumes the auction was garbage. Now, what do you learn from this scenario? When do foreign central banks get dollars? Through global trade. And when global trade is expanding, which is inflationary, then foreign central banks have dollars and they buy treasury securities. So what does that tell you right now when you see less demand than last month? Not significantly less. I think a couple billion less. It's not overly relevant, but what is that telling you? There is a dollar shortage. It tells you that global growth is shrinking. It tells you they don't need treasuries, they need other stuff, so they can't buy as many. And that is, of course, gets billed out as something so terrible. But yet, of course, primary dealers seem to want these things because they know there's going to be a demand for them. And there will be. And when you see it come, you'll be amazed. So I don't see how that's really all that bad, but of course, it's just because of that one piece that didn't go quite as good as in the past. Let's look into where are we at? Friday data, yes. Mainly what I'm interested in here is inflation expectations. So if you look at the University of Michigan 5-year inflation expectations, it fell 2.4. So it's notable that central banks don't think there's inflation. Consumers don't think there's inflation, but investors think there's going to be rampant inflation. It's going to be just crawling all over the place and rolling around the floors and piling up all over the place. And if you look at a chart of this, the lowest this has ever been is 2.2. So inflation expectations are 2.4. Second lowest print on record, right? I mean, that's as low as they get is 2.2. Well, I guess it meant 2.32. So third lowest. And if you look back and you zoom this chart out, it tells you that inflation expectations are super low. There isn't any. The only inflation expectations are in the hearts and minds of investors. Anything else of interest, we'll move on to the M2 money supply, because there is some interesting stuff here. Oh, you know what? I want to talk about this. So first, a lot of people are like, oh, and Steve's so wrong, infinitely wrong. He's so wrong. He makes wrong people look, right. Yeah. There's one thing that doesn't change from this whole picture. It's contraction in lending. And so I want to show you this chart of all loans and leases at all commercial banks. And what you can see, now you have to use your imagination a little bit, because this is on a year-over-year basis. So I also look at the 6-month and the 3-month rate of change. And the reason I do that is because that leads where the year-over-year rate is. So wherever you see the blue line, move it backwards a little bit, and you'll know where the 6-month is. And move it back a little bit more, and you'll know where the 3-month is. So what you see here is a decline in the year-over-year rate of all loans and leases, and lo and behold, in red, Treasury yields went down. And then you see it during this recession here. Loans and leases were going down. That means the 3 and 6 month were contracting ahead of the 12-month, and yet yields went down. They didn't go up. Now remember, everyone says yields are going to go up. This time is different. It's always different. And here we have the dot-com bubble. Look, loans and leases went down. And yes, yields did back up a little bit, as we pointed out. And that happens during recessions. And then, boom, they go way down. Yeah, okay, that's true. Well, how about the great financial crisis? Surely there's something wrong here. Oh, no. It went up. Yep, see, yields are going up. Oh, and then they crashed. How about now? Because now it's always different. It's always the next one that's different. If you were betting on something and you looked at 1, 2, 3, 4, 5 recessions, all did the same thing, this time investors are purely convinced it has to be different, because everything's different this time. Even though it was never different before, it's different this time. We have a very small backup in yields, not even close to what we saw in any of the prior recessions. Not even close. And where is all loans and leases right now on a 3 and 6 month basis, starting to contract? And yeah, this time somehow, Steve, will have to be wrong, because interest rates have to go up. This time is different. Well, it's not different. Let's take a look at the M2. And what do we see here? The M2 rose slightly, and most of that is in savings deposits, because we saw in the M1 a drawdown, so mostly in demand deposits. So checking accounts down, saving deposit accounts up, and institutional money, which is flowing into the market, fell a little bit. So money moved into the market. Let's take a look at assets and liabilities of all commercial banks. Probably the most important thing on Friday that comes out. What do we see? The bank credit expanded a little bit, about $16 billion. So banks, that's a positive for the banks. The problem is most of it came from the fact that they bought $10 billion worth of mortgage. Well, they bought more than that of mortgage-backed securities. They actually bought, looks like $12 billion of mortgage-backed securities. They had to sell off about $6 billion of their treasuries, and they bought some other bonds, non-treasury and agency securities. Oh no, they sold treasuries. Yeah, well, that happens. I mean, they do have to feed the Fed $20 billion a week, but keep in mind that long-term interest rates, if you look at long 30-year rates, which is what I'm mostly interested in, that's largely affected by the mortgage market, because guess where people get 30-year loans from? On their homes. So the fact that banks are now sitting on a record amount, again, of treasury and of mortgage-backed securities should tell you they're pretty confident in what direction rates are going, or what the Fed's going to do. So how about all loans and leases at commercial banks up $5 billion, with commercial and industrial loans up $4 billion, residential real estate up a massive $1 billion. So not much going on there. Commercial real estate always shocks me when this goes up. Right now at $3 billion. Who wants to lend in the commercial real estate market? I don't know. Consumer loans up $2 billion, with $1 billion on credit cards, and then $1 billion in other loans. So not a lot of demand here. Yeah, it went up a little bit, but hardly anything to say that there is any real demand going on in any of those areas, except for the fact that banks are buying bonds. Again, the key thing here is, what are the banks doing? I made a note to talk about Sorcerer JP and the FOMC. That's a great band. Someone should sketch that up. Well, those scurry little rats are meeting next week on the 4th and the 5th after the election. Now, what are we seeing in the bond market? Well, we've seen this notion that the auctions aren't that good. Will the Fed raise their QE purchases? Maybe. I don't know. They have one more opportunity in December to do it. I'm kind of curious. I think there's a chance that they do. I already saw the schedule, so I know they've got a schedule out till the following week in November. Not a big deal. They can fix that pretty easy. But I'm really curious to see if they increase it, because they've got some reason to do that. Stocks have come down, the volatility's up, which we'll look at. So there's all, the auctions, aren't seeing a big purchase from foreign investors. It's got every reason the Fed could now do something, right? No stimulus, so they've got all these reasons to do it. So the question is, what do banks want? Well, they want lower interest rates, and some of you are baffled by that. Well, why would they want lower interest rates when they make more money on lending on higher rates? Would you think they could get away with lending on higher rates today? No, they can't. I mean, we're not getting lending growth at the low rates now. I mean, if they doubled rates, are they going to get a flood? I mean, a bunch of you going to run in and start borrowing? No. Now, why would the banks want lower rates? Because when interest rates go down, what goes up? Oh, that's right, bond prices. And they're sitting on what? Over 4.5 trillion of bonds. Wow, that could go up. That could be a lot to the banks. Now, why are they trying to drive rates down and crash the system to lend if that doesn't make a lot of sense? Because it doesn't. Is because the government will come in and they will start backing loans. Maybe they'll raise the FHA limits, or maybe they'll do some other stuff. But that's what the banks want. They said, look, we don't make a lot of money at these low rates, and we take all the risk. Well, if the government comes in and says, look, we'll stabilize the lending market, we'll put some guarantees on, taxpayers will back it, then banks will start lending. That's what they want out of this picture, is lower rates to make money on their bonds, and the government to come in and guarantee the loans. Looking at the charts, the M2 money supply growth rate is up or down slightly on a year-over-year basis, down quite a bit on a 6-month rate of change, and up slightly on a 3-month rate of change, as we kind of saw that the M2 is flatlining here. Now, that's on a year-over-year basis, but it's flatlining. The monetary base is at 4.88 trillion. This actually, data came out last week. I assumed it was coming out at the end of the month because it's monthly now. The 12-month rate of change is at 52.4%, which is outrageous and still rising, meaning the money multiplier is down to 3.82, down slightly. Again, if you're looking for inflation, you would find it here. But what we do know is the monetary base is now going to continue growing faster than the money supply, and that is deflationary. So again, you have all these people in the bond market on the wrong side of the trade, and I love it because the data tells me they're going to be wrong. I just have to outweight them, and well, it's great. I'm a macro guy. I'm super patient. How about real estate loan growth down to 2.46% from a year ago? Again, record low mortgage rates. And you have pretty pathetic lending growth. And check this out, on a 6-month and 3-month rate of change, they're both negative, telling you there's absolutely no growth going on in real estate, residential real estate loans, and that does not spur higher interest rates. This does not lead to higher interest rates. How about commercial industrial loans? 12-month rate of change was up, so was the 3-month rate of change, both up slightly. But the 6 and 3-month rate of change, we have 6-month at -10, 3-month at -5. I mean, that's massively negative, telling you that interest rates are not going up. I mean, the market can short them all they want, but they keep running into a wall. How about loans and leases and bank credit? Growth rate is down to 4.87, which is now back to almost trend around 5% and falling. The 3-month rate of change is saying that's headed even lower because it's at 3.62, and the 3-month rate change is at 1.5, up slightly, also confirming that this thing is headed lower. And how about consumers, credit cards? Right, down to 10, flat at 10.2% from a year ago. No growth coming out of here. So again, nothing that's telling you. I mean, this is what macro is you build your thesis out, and you find the highest probability way to invest it with the least amount of risk, and you buy in, and then you wait and you check your data and you say, is the data right or wrong? And as long as it's consistent, you just sit back and wait and go through your data and wait for it to play out. That is the way you do it. Let's take a look at the charts since we have a few minutes left. And I want to take a look at volatility. Volatility is about to spring a leak higher, and this should scare equity investors, but they are determined by buying the dip in the last 30 minutes of trading today. And you can see that volatility is, remember I said it gets over 31, starts to get fun. It's now holding over 36, suggesting that it is at a critical juncture here, that either it's going to shoot higher or it's massively. I know, it's like, well, that's easy, Steve. You could just pick either direction. You're right. It is easy. It's got to go lower, or the risk is this thing is now going to repeat what happened in March, maybe even worse, because the setup here is even worse. The economy is so much worse than it was in March. Market freaked out because we shut down. The economy is super weak. And if you look at the trend lines, the moving averages, they are rising. And that usually is not good. When they started rising back there in March, that signaled that there was an event coming, and it just happened to get a catalyst. So now you have the trend is upward, not good for those who are long the equity market. But how about bonds? Poor bonds keep getting sold. And that's great, because the more people that are selling, the better it is. I love it, because it means they're all going to be desperate to buy back. And you have this fantastic wedge pattern going on here. Someone pointed this out on Twitter, and they're right. I have the line drawn in there, had it there. Here's a wedge. Remember, everyone said this is it. Bonds are going down, 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 down. And then buyers came up, broke through that wedge. Now, what is the point of a wedge? You see selling here, selling here, selling here, and then those sellers get squeezed. If they're short, or maybe they want to be long, they come back, chase that up, and they get squeezed out of their short positions. Now, this wedge is even worse because it's longer and it's got more opportunities to sell. See, people sold here. They sold all along here at 165. They sold here, came back up, and they sold even more. And the banks, meanwhile, bought about $10 billion in bonds during this down move here. And of course, what do we hear today? That this is it. Finally, interest rates are going to go up. I mean, that what we heard a week ago, that was going to happen. That didn't happen. And we heard that here. That didn't happen. Heard it here. And look, this is the biggest bull market in bonds that won't die, because all the things are saying that bond prices are going to rally, interest rates are going to fall. The only question is unless you're macro and you're very patient, do you have the time to wait it out? But what's cool for me is I know that when this thing breaks back up over this downward sloping trend, it's got short sellers here, a lot of them here, and up here to bust through, because we know based on the open interest, we know there's a 4 standard deviation short position. We know everybody's been selling bonds and nobody owns it. And that is good. And what could be the pin that pulls the grenade loose? And that is the dollar. And I apologize to all of you who have been meaning to cover the dollar, and I keep forgetting. This is about as clean as a bottoming pattern as you can ask for. You've now got the 50-day moving average rising, which is what you want to see. You've got it moving above it. Now, does that mean it can't come down one more time? It could, but if the dollar slices through the 100-day and starts moving up into the 96 range, you've got a clean cut bottom here in the dollar, and now you're off to the races. But this is about as good as it gets. I mean, we could, again, see another pullback, but from a bullish standpoint, you've got the dollar getting ready to take off, and that is what's going to unwind the equity market. Now, at some point, the bond market will turn around, and we'll see buyers coming back in. But what you're seeing potentially now is people just either being forced to sell bonds because they're trying to hang on to their stocks, or they're shorting bonds to get money to buy stocks. They're selling what they can because they want to keep what they want, and they don't realize that they're going to want to keep this. They just don't know it yet. And as far as I'm concerned, well, it's all you want, because the more you sell, the better it's going to be when it goes back up. Because like I said, made pretty much all my money waiting and being patient on a long-term view. So, I don't care about a day, a week, quarter. Sometimes I don't even care what happens in like a year, because as long as the thesis is correct and data is correct, it all plays out correctly. I will see those of you who like the chart show on Sunday. We should be pretty interesting. Then we'll be back on Monday. Of course, we'll have the election on Tuesday, and then the Fed the sorcerer JP and the FOMC meet on Wednesday, announcement on Thursday. So should be make for pretty interesting next week. I'm Steve Van Metre. Thanks for watching. Have a great weekend. Bye now. The content of this video is private education information only. Not intended by investor advice. It shows not to be construed as a recommendation or solicitation by or selling security, financial instrument, or participating in any particular trading strategies. Videos prepared by Steven Van Metre on personal capacity. Opinions expressed in this video and that afternoon do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial.